Hi, this is Randy Finney with the right side of the chart, and this is a late session update for Tuesday, October 6, 2020. Just a follow-up to the earlier video today, but more so just talking trading strategy, what to do now if you did short today at the highs. Where do we go from here? Where's your next objective entry, long or short? Whether you shorted or didn't short. So, as you recall, this is a level I've been harping on for quite a while right here, right about 11,547, 550. And I mentioned, earlier today, we were almost there, so it was an objective time to short. You're not always going to get a pushback, especially when it's that well watched. That's why, suggested maybe shorting a little below there, because when all eyes see a level and it's so obvious, what's going to happen is often you don't get there. Now, I have little to no doubt that listen to my voice, think it's just completely random that Trump tweeted out. The catalyst for the move down, the fundamental catalyst, was Trump tweeting out. He told his peeps to back off, stop negotiating with the Democrats on any deal. No more negotiations till after the election. He promised a big stimulus package that he'll push through after the election. So, whether it's a bluff or the real deal, it doesn't matter. Now, from a technical perspective, I say this very often, and if you followed me for a while, you've seen it happen a lot. The news will very often coincide or immediately follow the technicals. And so what does that mean? In other words, we reversed there, right on cue, another test to that level. Now, let's say that tweet didn't come out till tomorrow. What might have happened is something like this, a little more upside till tomorrow, maybe the news comes there. So, it's not just some kind of magic formula, but you can see that these drops, and this one, I believe that, if I'm not mistaken, that was Trump going into the hospital. Was that Friday right there? But a divergent to high, bearish rising wedge breakdown. So a couple takeaways that I want to get out here. First of all, one reason that I like shorting on rallies into resistance is the reversals can come very fast. If you weren't already short and you don't have a hair trigger, you missed a good part of this move. This is a 2.5% drop in a matter of minutes in the Nasdaq 100, or maybe over. I have to measure it out. I'm talking about this drop here. Here, I'll tighten it up a little bit. I know sometimes it's hard to see in the videos. There it is. There's your drop, and the other takeaway here is that when stocks fall, they tend to fall much faster than they rise, and that's one reason that I love shorting just as much as I love going long. You can see that the drops. Here was a beautiful bearish rising wedge. Boom, there's the drop. There's another leg down, and you can see that they tend to be more impulsive, a faster drop, wiping out days of gains in a matter of just hours or a day or so there quite often. Same thing right here. We were at that resistance level and we hit it, and there's a good example of that where we hit it and we hit it and we kept trading on it, and then that was the big drop that finally came. Again, I believe that was let's see when that was. Yeah, I believe that was late Thursday. So here's where we're at. All right, so where do we go from here? Well, let me zoom back out a little bit. You can see that we did, by the way, since I did the earlier video, put in some divergences. I had since added those. I'm still, in and out of my desk. I can't sit for much more than an hour, so to lay down. I'm still not far from being asymptomatic. I have some good periods. Take Motrin, Tylenol. I've been living off that. And so in between, I'll get to do some updates here every day for you. And I am feeling a little better. I believe I'm turning the corner at this point. I'm just not behind everything. It's not behind me yet. But I wanted to point out, here's where we're at. And I'm going to get to QQQ and IWM in just a second, and then we'll wrap the video up. Okay, so there's the trading range that I had, or at least the resistance level I highlighted. And there's your objective entries. Watch, rinse, repeat. Doesn't mean we can't take it out yet, but that's another impulsive round of selling. So it shows that this is where the bulls are getting smacked down, the bears are coming in, whatever you want to call the people. It's, in other words, longs are booked taking profits, sellers are stepping in at that level, and it's been a consistent pattern, and so far that pattern is now intact with another impulsive move down. And again, what I was trying to say there is, we traded there, and then boom, whatever was a news catalyst or technical catalyst. Now, here's where we're at right now. If you missed the move today, and you all of a sudden want to be short now based on what Trump says, and well, you missed, again, 2.5% drop. It's not objective. This is a support zone right here that runs from 11, 166, 80, about 11,167 to about 11,228 right there. And we're at the top of that zone. You can see, there's a lot of reactions that define that zone. Reactions. That's what I'm trying to show you how those lines come about. They're not just arbitrary. And that's it. So we're at the top of the support zone. And just like today, it was not objective, as I said earlier today, to go long right there, right into resistance. It's not objective to short when you've dropped down to support, especially a big drop like that. 2.5% drop from the highs. How much more is QQQ going to go down? It could certainly go more. I've seen the Qs go up or down more than 5% a day. But this is just kind of the noise lately we've had. This is the expanded volatility that we've had. That's why the VIX remains elevated. It's not taken off yet because the market, is kind of grinding around. This is bigger picture for the past few weeks. And so there it is. I just wanted to say that. So where are the next objective levels? Well, if you're a bull, you buy here. That's support. If you think the market's going to go up and take out the top of this range, or if you're just trying to trade the range, you could go long there. Not my preference. We've had now 1, 2, 3, 4, 5 rejections off that level, which increases the odds. Every time, think of it this way. When a stock is running into resistance, the more it gets smacked down, sometimes it can break out, and that's a powerful breakout. But what I'm seeing again are sellers just coming in and stepping out when the Nasdaq 100 hits that level. And so I'm still leaning to more downside. I think there'll be a break of this level, and that would be your next objective short entry. It would be ideal if we got a little bounce first, and then you could also look at that, bounce back to support or resistance on the way up. There's a level. Somewhat, it's a decent level, mild resistance, about 11,350 or so. And if you did short today, or even if you shorted right here, even if you shorted the rip, I can say this, that it's still an objective time to be short and have a stop just above those recent highs, and that's it. Especially if you're looking out bigger picture. So until then, this is the recent trading range. Wash, rinse, repeat. Be long or cover shorts at the bottom of the range. Sell longs or go short around the top of the range, and that's it. And if and when that level breaks, there's not a lot of, I could draw some micro levels, micro support levels along the way, but I suspect if it breaks, it's going to be pretty darn bearish. Why? Well, one reason, it's most likely going to indicate that this 60-minute divergent low, which again on face value is one of the most bullish setups. It is the most bullish setup that I've seen since the March lows. It's the first big, clear, positive divergence, on the indexes across all the index ETFs, small, large, mid caps, the futures that we've had since those March lows. But I already gave you in recent weeks some of the cross currents, some of the the bigger picture, and let's revisit that right now, and then we'll get to IW and we'll wrap it up here. So QQQ, if you recall, a couple weeks ago, I'm going to turn off all the lines here and point out that we had, as I mentioned, the first bearish PPO crossover in quite a while. Let's throw up the histogram that shows it with these red bars. When the PPO makes a bearish crossover, that's this right here, the PPO line down below there. And so last time we had, well, this was it right here. This was our most recent cross. There it is. And this is a weekly chart, so this paints a bigger picture. The last time we had a bearish PPO cross was right there. That's that drop into the March lows from COVID right there. So say what you want of it, but technically it was, telegraphed there before in advance before the drop was over. There was a big green hill, and I've already gone over this, and I measured these out. These corrections are bigger than they look. There was a big one back there in the fourth quarter 2018, again telegraphed in advance by that crossover. So that was one of the things, and still is, that makes me second guess the fact that that 60-minute divergent low that we put in is going to take the market to new highs, because normally in a bull trend, and that's, we've been in a bull trend off since March lows, clearly, it's just a correction so far. Normally those 60-minute divergent lows are the catalyst to the next big leg, the next new highs in the market. And these are again some cross currents. Now, a couple weeks ago I told you that the S&P 500 had not yet confirmed that, and it still has not yet confirmed that signal, but here it is. This is SPY. If you look closely, we do have a little red bar right there. You can see there's a reading. It also tells you it's negative 0.01. So we have technically we have a cross. However, it is not a confirmed signal. We need to see a red bar at 4 p.m. on Friday. This is a weekly chart. All that matters to me on this, using things like this, is how it closes the week. So this is something I'm going to be watching. And you'll have a good idea. I mean, basically, if, wherever we're at right now on SPY, right here, if at the end of the week we stay here or go lower, because the cross has already happened, we could trade sideways. Now, I'd like to see those crossovers solid. I don't like to see just where you have to squint to look to see if the line's crossed or if that bar is red or green. You want to see a solid bar down below. As I like to say, the redder the better. So we'll see what happens. And again, I just want to talk about where the markets are at. There's SPY pulled back to support right there today on the drop. Nice reversal. And then finally, last but not least, there's IWM. As I mentioned today, we were right up around resistance, that previous reaction high. That was the last time I gave a sell signal after a bull trend on IWM when that breakdown came, and that's where we failed today. You can call it coincidence, or you can say that's technical analysis. We're overbought into resistance. I gave 3 reasons why I favored a pullback in IWM, and again, look, not getting excited. This is, when you look at the drop here, as impressive as it was, if you're sitting there in front of your computer today watching the 1-minute charts, that was a 2.85% drop so far in IWM. But when you look at this 60-minute chart, turn off all the lines, it's really par for the course. Volatility, again, has expanded in recent months, and that's the new norm. So, look at these rips and dips within here, and this is really not, well, it is technically significant. Okay, it's not a random move. That's what I try to sometimes talk about when we have these big rips or dips. If they're random and they're in the middle of nowhere, no, it didn't break above support or resistance, a trend line, then that is random. Today, it was technically significant because it was the fact that we reversed impulsively off resistance where IWM should have if it was going to reverse. And now you can see on the 60-minute chart we have a pending bearish PPO crossover. So I do think that's probably mark the top. And here's the trading strategy. Right now, remember, QQQ came very close to right around that resistance level. IWM, as I mentioned earlier today and just now, resistance. So there it is. Stop, relatively tight stop above the highs. You could still short here. It's not the most objective time, but IWM has now bounced off that first support right there, 156.23. It's already retraced maybe, what is that, about a third of the move up. While it was more objective or ideal, especially now in hindsight, to short at resistance today, even though we didn't have a sell signal, we've bounced back there. And again, so if you look at it this way, if you have a stop above the recent highs, that's about 2%. And if you remember today's analysis, I spent a lot of time on this daily chart talking about the bigger picture in those trading ranges that we've been in, which I'll box in here. So this is what I wanted to do the video for. It's just kind of talk about bigger picture, because sometimes I know I'm all over the place with short-term analysis where I think the market might go today, tomorrow, and then sometimes I'm talking long-term. And so this is a swing trader's realm right here. And I've talked about, again, this was in today's earlier video. And when you recognize a trading range, like I said, if you missed today's video, we only popped briefly above and below that range. Well, this was a big one, but we snapped back into it. And this is the last over 2 years, back to 2018. The majority of the time, the IWM, the small cap ETF, has spent most of its time trading in this range. And when you find a trading range, it's a very simple and effective strategy. You go short at the highs or sell your longs, and then you cover the shorts and reverse and go long at the bottom. And you try to ride up to or close to the top of the range. Sometimes you reverse just shy. Here you hit the top of the range, sell longs, go short. Sometimes you can target the midpoint, or if you held it there, eventually you never went underwater, and then you went to the bottom of the range, top of the range, bottom of the range, top of the range, bottom of the range, top of the range. And then, there are, again, a few whipsaws through, but this has been the current MO. So where I'm going from a longer term swing trader, trend trader perspective, you could short today if you didn't already, or around these levels, and your pullback target would be the bottom of that range. That's about 145 right there, and that's about a 10% drop in IWM. So that is swing trader stuff. More active traders, go back to that 60-minute chart I posted today, and all these levels that were targets before, and that reaction there. You could have covered if you were very fast. This was the same level in the video earlier today, 156.23, and we hit a low of 156.34, close enough. I always say you want to cover shorts a little bit above the actual support level you expect a reaction, just like you want to sell longs a little bit shy of the resistance level you expect a reaction. That's in case the buyers or sellers step in early. All right, I think that's it. Let me see if there's anything else I want to cover here. Not really. The only other thing I would mention, I pointed out these negative divergences on RTY today. RTY is your small cap ETF. By the way, if you want to get your feet wet with futures, but RTY, the contract size, because they're highly leveraged. M2K is your mini version, just like on the ES is your S&P 500 futures, or you can do MES, you put an M in front. Same thing with the NQs I talk about all the time, the Nasdaq 100 futures, put the letter M in front, that's MNQ, and they just reduce, I think it's by 1/10 if I'm not mistaken, they reduce the leverage factor, but they trade to these same values. So in other words, it's this, you could use this RTY chart that I'm putting out here. The numbers are all the same on that contract. It's just a smaller leverage factor. So what happened today? Well, we popped that other previous high marginally by a slight amount, and then in a very impulsive rejection back down below. So what this is, as of now, this is a failed breakout, aka bull trap. When you take out the previous highs or resistance level, like there about 115.92, and then you fall back down below, especially impulsive. So as of now, you have a bull trap, aka whipsaw signal, and that would indicate, especially with these divergences, we're coming down to at least this level. That'd be my minimum target on RTY right here, 1546. And quite likely 1500, and maybe much more. Like I said, go back to that daily chart of IWM I just covered, and that's more of a swing or trend trader target, that 10% or so drop on the small caps. Okay, guys, I'm going to wrap it up here, get the video out to you, and I'll do updates on the other things, natural gas, coffee, coal stocks. I'm just not seeing a lot there right now or lately, so I'll update those in a separate video. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.